Welcome to the Savvy Property Investors Podcast, a weekly show that delivers the best hard-hitting property industry news, business advice, and talks that will get you ascending in the real estate industry. Now, here's your host, the amazing award-winning property and business coach, best-selling author, and serial entrepreneur, Miss Sapphire Gray.
Hello and welcome to the Savvy Property Investors Show. We're in season 2, episode 10, so you know we're coming towards the end. Today's topic is there still money in house flipping? We have a guest again, who's Jack, who's graciously going to discuss if there's any legroom in house flipping. So welcome, Jack.
Thank you for having me on the show.
Brilliant. Jack is from the property tech platform called Property Entrepreneurs Network, short for PEN. Jack has been running a business for the past 25 years and has developed a substantial amount of expertise in leading businesses and investments. Using this knowledge, he has helped companies create branding, increase sales, and brand value. Trying his hand in property tech, fashion, retail, and more, Jack is passionate about advertising, training, and inspiring people and help businesses to develop creative growth strategies. And for those looking to sell up, assist them in getting the most value out of sales and exit strategies. Jack's shown signs of being business orientated at a very young age, helping his family's business, but he suffered from depression and suicidal thoughts when he was 25. Jack has now spent his time building a property tech platform called Property Entrepreneurs Network, PEN, assisting property investors with their portfolio expansions, and is heavily involved in property development and property finance. I'm Sapphire Gray, your host, so let's get started. Jack, thank you again for joining me today. And I mean, you've been a guest on our show before. Love your content, love what you have to share, and our audience absolutely love you as well. So welcome and appreciate you being here again with us.
Thank you.
So let's dive in. Can you explain to our listeners what the term BRRRR means?
Oh, the BRR strategy, or the BRR or BRRR strategy, as they call it. Okay, so basically it's buying a property that's run down, renovating it, and then either selling it for a profit or keeping hold of the asset so to create rental income for yourself. That's what BRR is. So buy, refurb, renovate, refinance, rent, so on and so forth. This keeps going on, and you can rinse and repeat, and so on and so forth. If you ask me a simple question, as in, is it worth investing time into BRR? I would say no.
Okay.
Reason for that is, and I'm not saying there's no money in BRR. That's not what I'm saying. What I'm saying is that keep it as a side hustle.
Yeah.
Reason for that is because the market is so saturated. It's almost like after one rundown property, there's about 50 people to buy that deal. And then what tends to happen is that it ends up being sold for much higher than the market value, leaving very little profits at the end, which eventually makes it difficult to refinance and rinse and repeat that money practically. True. So in most cases, you end up leaving money in that deal. And at the same time, because it's a saturated market, so there's less supply than demand, the whole process becomes a lot more tough.
Yeah.
You could be bidding at an auction, end up paying much higher prices. You could be speaking with an estate agent, and this guy is doing block viewings, and they're showing it to 20 people at a time, and you're kind of bidding against each other. And eventually, my experience is that most people end up paying far higher than the actual value of that asset in that moment, in its existing situation, in its existing condition, leaving very little profit. So to answer your question in simple words, it's not worth investing your time and effort, but keep it as a side hustle, because every now and then you would come across a deal that will really stack up well.
So that kind of leads me into the next question: is in what circumstances would somebody use this method as an investor?
I believe that to be able to find good deals which really stack up well, which would leave you at least as a bare minimum 25% plus net on the GDV or the end value, and then you can take that money and refinance and rinse and repeat. The only way to be able to do that is by having very, very good relationships with your local estate agents. Unless you are at a point where you're actually having, like you socialize with these guys, and they don't put it out in the market, and they just come back to you and they know exactly that you're going to buy it.
Yeah.
If you can be in that position where a property comes to the estate agent, they don't put it in the market, they know exactly that you're going to buy it, they put it to you, it's sold, they make their money, they make their commission, and you end up getting good price on those deals. That is the only time I believe BRR can actually be really profitable.
I hear that. So typically we're on here talking about the BRRRR method, but also you specialize in flipping properties as well. So what's your first experience of doing that?
So my experience has been that, look, we keep it as a side hustle. We don't do it as a full-time thing in the first place. My strategy, in fact, I'll tell you something strange. I learned as a strategist, and I'm a strategist at core. I learned on a strategy level that you should always focus on one strategy at a time, one thing at a time. And yes, it does work really well because people tend to get to know you from that strategy. But what I learned from property business is that there's no right or wrong. In property business, because it's saturated as a property business in and itself. So I'll give you an example. Behind a land deal, if you put a land deal out, there's about 100 people for one deal.
Yes.
If you put out a conversion deal, there's about 100 people chasing that deal. If you put out like a BRR deal or a flip deal, there's 50, 70 people chasing that deal for a single deal. So the whole market in and itself is saturated. Okay?
Yeah.
And I believe that if a person is focused on just one strategy at a time, unless you have lots of investors to back you up, that's a different position to be in, because then you are sitting with 50, 100 million cash. That's a different position to be in. Then you can just take one strategy and focus on it. But if you're not sitting on that kind of cash, I believe any opportunity that you come across, you should take it.
Yeah. Okay.
And that's because you're just not going to be able to find that many good deals if you just focus on one strategy.
I hear that. But if you're a newbie starting out, would you still recommend that, or would you say still focus on one strategy? Because when I teach, I always say focus on one strategy. Once you've mastered that, then move off into another strategy. But if you're a sort of a seasoned investor, I agree with the statement you've just made. But would you do that with a newbie as well?
To answer your question, as a newbie, and I can tell this very, you could go and watch YouTube videos. You can go and take trainings for very, very cost-effective prices these days. Okay. I feel that if you are coming into property and if you just focus on one strategy, and I literally get approached by so many people, which strategy as a newbie am I supposed to focus on? It depends on how much money you have to invest.
True.
Where are you based? And at the same time, I feel that you should learn more than one strategy.
Absolutely.
Because one strategy is just not going to help you. Okay. One strategy at a time with less money in your pocket to invest is only gonna, it's just gonna make your life more difficult. So learn more than one strategy. Learn 2, 3. If you can learn more, great. If not, at least 2 to 3 strategies, and all of them become side of like the side hustles, eventually making it like a full-time commitment into property.
I hear that. So what has been your favorite house flip project to date?
So the one I'm sitting in, this has been very, very interesting. When I bought this property, it was actually initially sold to someone else. The buyer pulled out last minute. It came back to the market. I was the first person to walk in. It was valued at 330. And I ended up I put in an offer at 280, which is pretty low. But then we eventually agreed at 285. So I got it 45 grand below the market value. It was in a not necessarily in a rundown condition, but wasn't in the best of the condition. We ended up spending about 85 grand on top, which makes it about 360, 370. And then when we eventually got it valued, it was valued at 420.
Oh, wow. Okay.
But then the funny thing that happened is we were going through the period of COVID. And right at the end of COVID, when we opened up, I spoke with another estate agent. It was valued at 500,000.
Wow.
Okay. So going
What?
from 360-ish,
Mhm.
360,
Yeah.
370 to 500,000, that's a pretty good deal. We ended up moving into this property. We've really done this is a really, really high spec property.
Mhm.
We've invested lots of money into it, but we eventually ended up moving into this. We're going to live here for maybe 3-4 years. And then I'm eventually going to buy a bigger property than this. But this was an interesting one because, first of all, we ended up getting it below market value, which is unusual for a sort of a rundown or a poor condition property.
Yeah.
And at the same time, if I wanted to just do a basic refurb, I would have got away with 40-45 grand. But
Yeah.
we ended up investing 85 grand. But when an estate agent walked in, he actually said to me, guys, I do not know of any single property in this region with this kind of spec. And he
Wow.
goes, when we put it out in the market, we know that we're going to fetch a really good price. And at the same time, with the rising market through COVID, the prices in this area went up by 30%.
Yeah.
Pushed
Yeah.
up by 30%. So this came to be an interesting one. And like I said, we're sitting in it. I'm not necessarily using the money here, but eventually at some point I'm gonna convert this into a BTL and pull out the money and then take it back and invest into another project.
Absolutely, because traditionally a flip is when you buy property below market value, add your works to it, and then you sell it on for a profit. So you don't generally hold on to the asset, you're actually flipping it. Hence
Yes,
in
right,
the name.
That's
But
right,
in your
yes.
case, you've actually held on to it, which is
Yes.
to your advantage as well, because you know that there's a massive amount of equity that's built into the property anyway.
Yes.
So when
Yes.
it comes that time when you actually are selling it, you're selling it on for a profit as well.
A very, 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 very good profit.
Very good
Yes.
profit,
Yes.
absolutely. So what makes when you're doing a project on a house flip, what would you say are the key things that you need to look out for to make it a good flip?
Okay, so there's but few things that I can share. One, and this stuff I literally know 9 out of 10 people don't know this stuff. Okay,
Mhm.
one thing that people don't quite clearly have a clear understanding of it is that when you put in on raising the spec of the property,
Mhm.
when you invest, let's say, £1, you're more likely to make £3 out of that. A
Mhm.
lot of people take on these flip projects or BRR projects, and they do like a really minimum, like that put a very cheap flooring, that
Yeah.
put in a very cheap kitchen. They wouldn't invest into like the cupboards and everything else, right?
Mm.
Or even at the time of selling the show home that you create,
Yeah.
a lot of people actually they don't want to invest that money. And what they don't realize is that how many times have I seen when you invest that money, not just that you make your money back, but you make that money 3 times over.
True.
Okay. So
Absolutely.
when you are doing a BRR project, if you're either going to hold on or you're going to sell it, whatever it is, make sure that you raise the spec. So let's say an example would be, let's say in Greater London area,
Mhm.
if you walk into a property and you look at the spec, and let's say on a scale of 10 it's maybe an 8, which is
Mm.
what you're going to find throughout Greater London. You walk
Yeah.
into a Central London property, it's a 10 on 10. Okay. You
Yeah.
walk into somewhere near Fulham, you would walk into like a 9. But when you get into Greater London, you're looking at 8 on 10. Okay.
Mm.
Don't do that. If you look at an 8 in an area, push it to a 9, maybe a
Yes.
9.5,
Mm.
because then you're preparing that property for someone, a professional, a doctor, an engineer, someone who hasn't got the time but is prepared to pay for that luxury in their house.
Mm.
And you're eventually going to make that money, like I said, many times over. So that's one tip that I can give everyone. The second one is have patience.
Mm.
And I'll tell you why. A lot of people are into BRR projects and they end up taking properties which are not necessarily as profitable.
True.
And that's because they don't have the patience to wait for the right deal.
Mm.
And that's exactly the reason why I said that it shouldn't be your full-time thing if you don't have lots of money in your bank. Okay. If it's just if you have, let's say, 200-300 grand, 500,000, even $1 million you have in your account, it still needs to be a side hustle. It can't be your full-time thing. Unless, like I said, if you're at 50 and 100 million in your account and if your investors back, then it can be a full-time thing, because then you're practically doing at any given time 10, 20, 30 projects a year. And that means even if you make less money in one project, it doesn't quite matter, because
Balances it
eventually at
out.
the end of it, it's a volume game.
Yeah, absolutely.
So these are two things that I really kind of feel that people get it wrong. Don't think that you're going to go and look at 10 deals, then you're going to find the right deal. You'll be going through 50 before you find one decent deal.
Yeah. And I always say that when you're looking at deals, you've got to do a funnel of 50 and then start narrowing that funnel down.
That's right.
Assume that you're not ever going to find that golden nugget, even in that 50. You could go through 50 and still come out and not find a deal. But I always say you have to be consistent in your viewings, consistent in your numbers, making sure that they all stack up. And when you're looking for deals on flipping houses, that's where my expertise lie. I love flipping houses. I do buy below market value. I do fix them up to a high standard, but I also turn it into a show home. So if I actually kit it out and furniture it, so people, when they walk into that, they feel for the space, they can see and visualize themselves living there, where they're going to sit, where they're going to eat. I dress the tables, all these kind of things that I take into consideration.
A huge difference.
Yeah, and it does make a huge difference. And sometimes they even want to buy the furniture that I've put in there. So
in most cases, yes,
it's a win-win situation. So it's giving that visual when you're doing a flip, making it high standard. And even if you're not using expensive materials, if it's a small flip, still dress it out according to the market that you're in, according to where the property is located, and make people feel I'm walking into my home. The moment they feel that, the moment they want that property, and that's where you can make more money potentially.
That's right. Yes.
Other people go in there and see that property and think, well, I want it as well. What happens? It goes into a bidding war. People want the property and they're bidding on because they feel comfortable with the space. They've walked around it. They imagine themselves there. They're picking up their bags. They're moving in, and I'm home. So always consider when you're doing a flip to dress the property as well. Don't just do it and just leave it plain. Dressing it up, spending a couple of £1,000, kitting it out is going to do you more service than disservice. That's right, brilliant. Yes. I absolutely agree with that.
In fact, let me share with you another one, which we just did. I actually had this property for a very long time. I bought it back in 2003, but I was at a point of selling it. So I got it valued in 2017. It was valued at £97,000. I got it valued at 2018. It was valued at 103. I got it valued at 2019. It was valued at 107.
Wow.
I got a refurb done of 10 grand, dressed it up. I sold it for 138.
You see?
It was valued at 107, and that is a 31 grand pusher. That almost becomes like a 30% rise in the property value just by investing 10 grand.
Yeah. And that's what it is. You have to do your numbers before and what you're potentially selling. And always look at the market of properties that have sold in that area as well. If you know there's a margin in that area that you could reach, what are you not doing with your property that other properties on that same road is got a higher value on? And generally, it's the condition of a property. So when you invest your money in doing it up, you definitely will see a return.
That's right. Let me share with you another one which we went through as well, which not a lot of people know, but if you do your research, you will see. We actually sold 8 properties in total, 6 flats and 2 semis in Wembley, and we achieved 20% more than the normal market average that was going at that point for the per square foot value.
Yeah,
that is 20% above what was being achieved in that region, just because we raised the spec of the property to at least 2 points on a scale of 10. And we really achieved that 20%. And can you imagine if you're doing a development and you have 25% profit margin, but you push the prices up by another 20%, all of a sudden you go from 25% profit margins to 45% profit margins.
That's right. That's right. Jack, you're sharing a plethora of really good nuggets here. So join us after the break with more insights from Jack.
Thank you.
Like what you hear so far? Make sure you never miss a show by clicking the subscribe button below. Our podcast is only made possible by great listeners like you.
So Jack, welcome back. Thank you so much for all what you've been sharing and the examples you've given. What are some of the pros and of flipping a property, or cons of flipping a property?
Pros: if you can create a systematic way to bring in leads, as in properties. In fact, let me share with you a story that I came across. This was someone I got to know about 4 years ago. This guy was in Manchester. He managed to find a gap in the market where he was very close to one of the universities. And what he was doing was he was buying standard terraced properties, and so basically 3-bed terrace properties, and most of those properties were large size properties. And what he would do is he would convert them into either a 5 or a 6-bed property. He would do a slight extension at the back. He would do a loft or whatever. So he'd sort of expand the property or extend the size of the property. He started doing one, about 8 or 9 years ago. He did one. He'd get into the second one. He was actually an accountant. He did the second one, the third one. And what he realized was that he was buying the properties for like anywhere between 80 to 100 grand. And he was investing about 20 to 30 grand on extending. And then because they were going, and he was converting them into HMOs for university students there. And what he was doing was he was actually getting commercial valuations on those. So he would buy something for, let's say, 80 grand, invest maybe 30, 35 grand, 110, 115 grand. And then he would get valuations of 220, 250.
Wow.
Okay. So what he started doing was he started buying literally left, right, and center. When I met him in 2017 or 18, if I can remember, he had a portfolio of 10 million.
Wow.
And he had a team who was pretty much copy pasting everything. So literally you could walk into one of his HMOs and you don't need to see the second one. It was an exact copy of the whole thing. So one of the tips that I can give people is that if you find a gap like that, and you can find gaps like that every time, if you just put in the time and effort and have patience, if you find a gap like that, you're going to do really well. This guy found the right gap. When I met him in 2017 or 18, he had a portfolio of roughly about 10 million. He had about 46 units.
Wow.
The interesting thing is, forget about the 10 million valuation. He was fetching 25 to 30 grand rental on each unit.
That's it.
Okay. So can you imagine, even if you're working at, let's say 40 on a HMO, if our audience don't know this, I can give you the percentage of profits. You can make about 45 to 50% profit margins. If you are especially managing yourself, you'll make 50% profit margins after paying your mortgage and maintenance and everything else. And imagine, if he has got 46 of those units at 25 grand and he's making 50% profit margin, imagine the kind of cash flow this guy's sitting on. I mean, he could take that money and buy as many as he likes. He can buy 10 a year.
Yes.
Okay. So, but all he did was, you don't have to be very smart for this. You don't have to be very intelligent for this. You don't have to have a graduation. You just have to find the right gap. That means the right pocket where it's been unexplored and you can go and do this work. So this is something that I observed, and it's been a great learning curve for me.
Brilliant. And that's the thing. It's about understanding where you are as an investor. How to start looking at where is the gaps, because that's how people make money.
That's right.
Is looking at what is unique about what the service you're going to be delivering, or the strategy that you're going to be developing. And once you understand that, the strategy that you're developing, you just get on with it. You don't have to explore or jumping in with somebody and saying, I'm going to be doing this. You just get on with it, because you've got this unique strategy now that you're going for and building out your portfolio. And if it's working for you, that's fantastic, but it's always about looking for those deals. And when you find them, what do you do with them? So speaking on that, how do you find properties below market value, or fixer-uppers as we put it?
So going back to your first question, which was half a part, what are the disadvantages? And I'll come back to your second question. Okay. Disadvantages. How many times have I come across people who've actually taken on deals with not enough due diligence, and they end up, forget about making money, they end up losing money.
Yeah.
So if you are looking at property deals, make sure you do your due diligence well. Don't lose your patience. Oh, I'm struggling to find deals. Because the time you lose patience is the time you're going to make a mistake, or the time you get desperate for something is the time you're going to make a mistake. And I promise you, forget about making money, you can end up losing money on it. And I promise you, I've seen more cases like that than I can literally count on, where people have lost patience, they've become more desperate, and they've ended up investing into the wrong deal. In fact, one I want to share with everyone so that people can see what's happening. I had one of the developers buy a small piece of land, and he wanted to build, I think it was like a planning permission for 4 properties. He bought the land in an area in Croydon under the assumption, so lack of due diligence, under the assumption that this is the posh side of Croydon. And while it wasn't the posh side of Croydon has 2 sides of it, and so does many areas in UK. Croydon has this very posh side where properties are very, very expensive, and you take the same property and you put it on the other side, and it's barely 2/3 of the price. And he literally bought that piece of land under the wrong impression, ended up eventually losing money because he didn't develop. All he did was he actually sold that piece of land because it just wasn't stacking up anymore, and he ended up losing money on it. So going back to BRRs as well, the same formula applies. Please don't get desperate that you're not able to find deals. Don't lose your patience. It is actually just literally going to go against you. To your next question, please, could you tell me again? Could you ask me again?
So how does people find below market value properties and fixer uppers, and then how do you decide which ones you should avoid?
Okay, so there's a couple of things I can share. One is learn to use your online tools. Okay, again, how many people do I know who just literally do not focus on using Zoopla and Rightmove effectively? If you go to Rightmove or Zoopla, there's actually a filter tab which actually gives you the option of the most reduced properties.
Yes.
If you use that, it will help you find below market value properties. Can you find them day in, day out? Yes, you can, if you're doing this full time. And if you're creating those good long-term relationships with local estate agents, you can do this day in, day out. So using your online portals effectively is very, very important. Rightmove, Zoopla on the market. You can find these filters on all of these platforms, not just the most reduced, but there are properties which have been on the market for the longest time. And sometimes people cannot see the potential. And if you know what you're doing, and if you can see the potential, you understand local planning, you understand PD rights, if you know all of that, which most people do not, and if you learn that, you have an added advantage, or you have an advantage on top of everyone else, where you will be able to see the potential in properties. That is very, very important to learn. At the same time, below market value properties, good relationship with estate agents just go really, really far. Also, I feel that direct to vendor letters really play a good part. I also feel there are a couple of the portals, Nimbus Maps, Land Insight. These are very, very good tools to find below market value properties, HMOs,
property data,
potentials, property data as well, potential of properties. These are very, very good tools to use. So make sure you use these tools to your advantage. But like I said, one thing that you cannot swap or exchange is your relationship with your local agents. That just really, really goes far. I mean, I can tell you about me. When I see an estate agent, I buy them drinks. I'm buying coffees, I'm buying drinks. I'm asking them, to let me take you out for a dinner. I promise you, you buy them 10 dinners, it's going to cost you 500. They're going to come back with one deal. You're going to make 50 grand, 500 grand. Okay. So that money will always pay off. So make sure when you are going out on social, make sure you take lots of estate agents with you. And when you are doing your events, or when you're doing something special, make sure you invite these estate agents. Make sure you create your inner circle and you invite these estate agents so they can benefit from your network, eventually them leading to bringing deals for you.
I totally agree with that. And I always, when I'm teaching, always say, I want you to register with 50 estate agents and become friends with them. Phone them up, get connected with them, get them to know who you are and what you're looking for. Take them out for a coffee so that they can get to know that you're a serious investor and this is what you want to do. If you're going to events, if the exhibitions are now starting to open up, so visit these exhibitions, get to know the exhibitors, understand your market and who you want to be doing business with. And once you understand that, the world's your oyster.
It is. It is, no doubt about that. The, the funny thing is, one thing again I have observed is that it's one thing, kind of creating those relationships,
Mm-hmm.
but make sure that you live up to your word. Because if you tell an estate agent that I'm going to buy this property and then you don't deliver on it,
True.
you and believe me, estate agents talk with each other. Okay,
Yes.
so if you don't deliver on your words, you'll end up creating a bad reputation, leading to those people not wanting to. They will still talk with you, but they just won't bring you the real deals. Okay,
That's
so
right.
make sure you deliver on your word, whatever it takes.
Yes. When you're looking at building out this flipping properties, how would one person go about calculating the after repair value?
um It's a good question. I think it comes with experience. I don't think there is a written rule that you can potentially follow when it comes to refurbs. I have seen refurbs. In fact, let me share with you one that we actually sourced that property. When I initially looked at that property, and I sent a couple of builders around, and they said it's going to cost you anywhere between 100 and 120 grand. Eventually, when we sourced that property to one of the seasoned investors, developers, he only invested 40 grand and he brought that property up to a really good mark. So it's just a learning curve I went through as well. And my observation is that sometimes we look at a property and say, oh, this is going to cost a hell lot. But if you dig deeper and say, can I maybe, without skimming the property, can I get away with just a paint? Look at the flooring and say, do I need to put an engineer wood flooring, or do I need to, can I get away with the basic flooring? So stuff like that. Also, procurement plays a major part. Having good relationships with suppliers as well plays a very good part. But at the same time, like I said, I think this comes with experience. There's no written rule, and I don't think a single podcast is something that I'd ever be able to explain in the first place. A rule of thumb. In normal cases, let's say if you're doing a conversion from a commercial to resi, I can tell you a rule of thumb. It's going to cost you anywhere between 25 to 30 grand to convert an office to a resi, a single unit. But you could take the same formula and apply it to a house. Okay. And if it's just a basic conversion or basic refurb, it shouldn't be any more than 20 grand, 25 grand, maybe 30. But if it's to do with structural changes, it may cost you more, and then obviously you need to speak with a builder. Yes,
absolutely. And I always say this as well. I always look at properties that are currently on the market in that area. I visit those properties in that area I'm going to spend in a substantial amount of money on the renovations. So I will go into the area, look at some houses, see what their prices are on the market, go back to the house that I'm actually looking at and think, well, if I put X amount in, I can not only make a higher profit, I'm also adding more value to the street value as well. So that's sometimes, and speaking to local estate agents, what your properties could sell for actually gives you another advantage as well. Because if you're looking at 3 different estate agents and ask them, what could this property be sold for? You're not going to go and put a 50K investment in to something where it won't give you that 50K investment return plus. So always know your numbers, do your due diligence with other properties in the area, do your due diligence with not over developing a property as well. So not putting more in that property than it actually needs to be. Don't over improve it, in fact. Go ahead.
Here is something that I learned. Okay. Let's say you go and speak with 3, 4, 5, 10 local estate agents. Don't take their word for it. Reason being, estate agents are sitting in the market to make money.
Of course.
They are actually there, yes, to serve and everything and help others as well. But at the core, they want to make their money as well. So sometimes what they tell you may not be as accurate. What do I mean by that? Sharing my experience on dealing with estate agents. I had, in fact, this is the Wembley deal that I was working on. We actually had spoken with nearly 10 different estate agents. And this is me personally doing it because I was operationally involved in that deal. So I called up about roughly 10 estate agents. I made a spreadsheet of all the estate agents, And then I started writing all the numbers they were giving me on the property deal.
Mm.
Like I said, we ended up, and I think you know Foxtons. Foxtons
Yes.
normally are the ones who come in and they give you the highest price for your property. Okay. Foxtons came in, they gave us a price. We had the 9 others, slightly lower than what Foxtons gave.
Mhm.
And we ended up selling those properties 10% more than what even Foxtons gave us.
Wow.
Okay. And that's a very good example for everyone who's listening, that look, don't take the estate agent's word for it. Always test the market.
Absolutely.
Always, when you're putting the property out on the market, don't write price, write guide price,
Yes.
write asking price, write asking over. Play
Yes.
with the words, test the market,
Mhm.
because estate agents can only tell you what they know in that moment. But if you test the market well, you can always achieve more. Remember, you don't need 20 people bidding for your property. If you have 2 people bidding against each other, you could achieve really, really good price.
Absolutely. Jack, you've been phenomenal today, sharing your great insights. So how can our listeners contact you and learn more about the services that you actually offer?
So get in touch with us. You can find us on social media pretty much everywhere, with Jack Dawhra, as in Jack, Jack, with surname Dawhra. Connect with us on LinkedIn, Facebook, Instagram, TikTok, whatever else is out there. We are pretty much everywhere. Send us a message. You never know, there might be some synergy. We might be able to work with, closely on a project. Send us a message. You never know, there's always business to be done. We are a pretty large network, so connect with the network, not just with me personally necessarily, but there's a huge network out there which will eventually help you with every challenge that you might potentially have in your business, in your property business, right down from the start of finding deals to negotiating, to builders, to architects and consultants and planners and so on. The network is there to help you out.
And the network is brilliant. Penn, always, as Jack will put it, it's the Penn family. It's a brilliant community to be in. All the insights are in there. Everyone communicates. I've met up with a couple of people accidentally on Saturday, and part of the Penn group. And it's brilliant to always meet people and share insights. And each week we really get together and dive into different insights that Jack has to share. So, reach out to him. He's got a brilliant platform. He is all over social media. We'll be also sharing his links with our listeners. So please reach out to him. So come on, savvy investors, let's take flight. Don't forget to subscribe, rate and review. Also download our podcast every week. You'll find us on Apple, Spotify and all the regular platforms, and also on YouTube. This has been the Savvy Property Investor Show. Thank you for listening.
This week's episode of the Savvy Property Investors Podcast was brought to you by our sponsor, the Savvy Women Group. Thank you for tuning in. If you enjoyed today's show, head over to our website, www.savvywomen.co.uk, to gain access to our free resources and more insights about our guest speaker today. Remember, we make your business our business, so you can unlock your full potential and improve your quality of life.